Hello and welcome to the September 2020 edition of the CUNA Economic Update. I'm Jordan Van Ryn, Senior Economist at CUNA. And in this update, I'm going to be going over the economy and what we expect for the recovery, how long that might take, and also give an update for the credit union forecast and what we're seeing with credit union operations. So let's go ahead and get started with the economy. The COVID-19 pandemic has really been unprecedented, as I'm sure you are all aware. This caused an increase in the unemployment rate officially to 14.7%, really the highest in decades. And after making some adjustments for people not responding to the surveys in the proper way, the BLS actually found that the unemployment rate went up to about 20%. This is the highest since the Great Depression. So really unprecedented unemployment. Over 20 million people losing their jobs. The good news is that this unemployment rate has come down considerably since then. And in August, it fell all the way to 8.4%. Adjusted, it is a little bit higher at about 9%, but still pretty strong job creation considering we're still in the middle of the pandemic. We've gotten back over half of the jobs lost at this point. That said, there are a couple of important caveats to this report. One important caveat is that a lot of these jobs were temporary census workers. There were about 250,000 temporary census workers. Obviously, that does not represent permanent job creation. So that kind of brought down the unemployment rate further than it actually is. Another important caveat is that a lot of these remaining unemployed workers are now becoming permanently unemployed. So it's going to be harder to get those remaining jobs back. And that's why we only have the unemployment rate dropping to about 7.5% by the end of this year and about 6.5% by the end of next year. The job recovery, as you can imagine, has been very uneven. So certain sectors are doing quite well. So these include like online retailers, for example, Amazon, and places that can easily adapt to the pandemic and continue serving, or maybe even have a certain comparative advantage. You can see, for example, business and professional services, those jobs have almost entirely come back compared to 4 years ago. They still have a ways to go to come back to February. But these are jobs that people can do often from home and remotely. And so those have come back a little bit quicker. Retail has also come back relatively fast due to online retail sales, places like Amazon, and then other places that can adapt to online sales. But certain sectors, of course, like leisure and hospitality, is still well down over 4 million jobs since February. Now, this graph shows the time it takes to recover in months from each of the past few recessions. So this shows the fall in unemployment and how many months it takes to recover down here on the horizontal axis. And each of these lines represents a different recession going back to the 60s, 70s, and all the way up to the 90s. You can see on average, these recessions took about 1.5 to 2 years to recover the jobs lost during each of those recessions. Now, in more recent history, we can see, for example, the recession in 2001 took quite a bit longer, almost 4 years to recover from that recession. And the Great Recession was actually one of the longer recoveries in history, took nearly 6 years to recover all of the jobs that were lost in that particular recession. So now we're faced with this current recession. We had an unprecedented decrease in jobs, over 20 million, really high spike in unemployment. You can see that's represented by this decrease in over 14 percentage points in the unemployment rate. We have recovered over half of those jobs. And now the question is really, what happens from here? A lot of people initially thought that we would have more of this V-shaped recovery. We would be able to temporarily lock down, get the pandemic under control, and basically just open everything back up again. And maybe within a year or so, we could get all of those jobs back. Now, unfortunately, that forecast is looking less and less likely the more this pandemic continues and the more that people are staying at home and businesses remain closed. Some people think that perhaps in about 2 years, we could get the jobs back. But more and more likely, it's looking like maybe 3 years or more. And a lot of people you might have heard have referred to different types of recoveries, like a V-shaped recovery or U or W. And now actually the consensus is landing around sort of this Nike swoosh shaped recovery, where we have this big downturn at the beginning and kind of this steady increase in unemployment over the next couple of years. So it's good and bad news. The bad news is that we're going to be in this still for a while with elevated unemployment rates, business closures, people out of work. The good news is that if this holds true, it would still be much faster than the recovery from the Great Recession, for example, and perhaps even faster than the 2001 recovery. This is a recent survey by the Wall Street Journal of economists, and you can see that nearly 70% of them believe that the recovery will be this Nike swoosh-shaped recovery. A small minority, only about 15%, still believe that we'll have a V-shaped recovery. And a few others believe we might still have, for example, a W-shaped recovery, where there's an increase and then another dip and another double dip recession due to, for example, an increase of the coronavirus in the winter months, or other things that could happen in the economy, such as a contested presidential election, or as we see some of these natural disasters like the fires or hurricanes, that could certainly cause another recession as well. An important thing when thinking about the labor market is the composition of unemployment. And at the beginning of the recession, only about 10% of the unemployed were permanently unemployed. The vast majority, nearly 90%, believed that their job loss was temporary and that in a few months they would be back. Now there are fewer unemployed, but you see that nearly a third of the unemployed are now permanent. So as more of these unemployed become permanently unemployed, typically those jobs are much harder to get back. We can see, for example, data from the job website Indeed shows that compared to the same time last year, the number of job postings is still down about 19%. So in other words, even if people would like to get back to work, there just aren't as many jobs out there. How are consumers feeling in the current environment? Well, consumers make up about 70% of total economic activity in the United States. So it's really important how they're feeling and behaving. And you can see we had one of the steepest declines in consumer confidence in history a few months back when the pandemic first started. And it stayed at this relatively lower level over the past couple of months. Interestingly, consumer confidence is still higher than it was, for example, during the Great Recession and other periods, but still we have not seen any increase in consumer confidence that might get people to feel more comfortable spending and borrowing as they would prior to the pandemic. How have businesses been affected by COVID-19? Well, this is from the Small Business Pulse survey, and you can see that if you add up all of these, about 75% of small businesses say they are either moderately or negatively affected by the virus. Another 17% little or no effect, and then really only a small minority say that the virus has had no effect. Small businesses employ about half of American employees, so what happens to them is really critical for the recovery. And these small businesses are going to be in a situation where they don't have as much savings, they don't have as much access to credit to be able to really withstand a permanent closure. This is data from Yelp, and you can see that, again, at the beginning of the pandemic recession, most of the business closures were temporary. But as time has gone on, we see now that about 50% of business closures on Yelp are now permanent. So again, just like with employees, as businesses close permanently, it's going to be a lot harder for them to ever be able to open up. We can see that, for example, also reflected in bankruptcy data, where so far through August, we've had about 424 bankruptcies. This is the highest since 2010, and this is still relatively early in the pandemic. We know that part of the long recovery from the Great Recession was because all of these businesses closed. So the more businesses that become bankrupt, the harder the recovery is also going to be. One bright spot in the economy is that, unlike the Great Recession, home values continue to increase, and the mortgage market has actually been very strong. This is data on the average value of a single family home from Zillow, and you can see that it's only continued to increase to over 250,000. Nothing like this big decrease in home values that we saw during the Great Recession. So this is important for a number of reasons. One is just that the mortgage market continues to remain strong. As I'll show later, this has really driven lending growth at credit unions. But also, if people continue to have equity in their homes, those that own homes feel wealthier. They can always draw on that equity, and they're in overall a better shape compared to in the past recession, when a lot of people were underwater in their homes, which led to a lot of foreclosures and bankruptcies. We see also from the delinquency data, mortgage delinquency rates, that so far, actually, the credit union delinquency rate has not increased at all. We see a little bit of an increase in delinquencies among bank mortgages. And that makes sense. As you can see, for example, during the Great Recession, banks tend to do a little bit riskier mortgages. They did a lot more subprime mortgage lending, for example, in the mid-2000s. So we see their delinquency rate going up a little bit quicker than credit unions. But overall, mortgage delinquencies remain quite low. And that's partly because, of course, banks and credit unions are really trying to work with their borrowers to have loan modifications or deferments or forbearances to get them through at least a few months. But of course, the longer this goes on, when a lot of those programs end, we could see a spike in delinquencies at that point. Renters, of course, are a very different story. There are a lot of people, of course, that are not benefiting from the increase in home values, not benefiting from the increase in the stock market either. And we see, for example, back in July, about 1/5, about 20% of adult renters were saying that they were behind on last month's rent. And this is not equal across populations. This is much higher, for example, for people of color, like Blacks and African Americans, Latinos, and other multiracial categories. These folks really benefited from the government stimulus. So as further government stimulus seems less likely, these people could be in a really difficult situation, especially if evictions are allowed at some point in the near future. Now, we can't really talk about the recovery without talking about the vaccine. This is from a McKinsey study back at the end of July. And this graph might be a little hard to see, but it basically just shows you that there are more than 250 different vaccines currently in development at different stages, different types of vaccines. And overall, the McKinsey report concludes that a vaccine should be available for focused populations somewhere between the fourth quarter of 2020 and the first quarter of 2021. Now, since then, in the last month or two, it looks like this is going to be even a little bit later, probably not till the beginning or middle of next year. And it's important to keep in mind, too, that once we have a vaccine, that doesn't mean that we're going to immediately recover as an economy. There are a lot of other things that need to come into play. For example, you need to just manufacture enough doses. This report says that there are plans for about 1 billion doses by the end of 2020, but ultimately we need about 8 to 9 billion, and that wouldn't be available until the end of next year. There's also questions about how effective the virus will be. Historically, most early vaccines are not terribly effective, and they only become more effective in later variations of the vaccine. There's also a question of targeting. Who will be targeted with the vaccine? Ideally, this would go to frontline workers, people that are at high susceptibility of risk and more densely populated places. But this is very challenging to do logistically, so that can create complications as well. And there's also a question of adoption. There have been surveys by Gallup and others that show that anywhere from about 1/3 to half of Americans would not be willing to take a vaccine, even if it were available, maybe due to distrust of science or misinformation. So that would also, of course, delay the effectiveness of a widespread vaccine. So what do other economists think besides just me? I can show you a couple of surveys. This is the NABE policy survey, the National Association of Business Economists. And you can see here that about 70% or so believe that we will not be back to our normal economic activity from the 2014 fourth quarter until about 2022. And about half of these economists believe it won't be until the second quarter of 2022 or later. So again, just helping us realize that this is going to be a relatively long recovery. And so much is going to depend on further government stimulus and whether the government is really able to step in and provide more unemployment benefits, direct stimulus payments, support for government, schools, businesses. This is a survey of the University of Chicago Booth experts, and it is asking these economists what they fear might happen without an extension of benefits after September 1st. Now, of course, we're in the middle of September. We know these benefits have not been extended. And unfortunately, Congress at this point does not look like they're going to be able to do another comprehensive bill, at least before the election. And you can see these economists are really worried that this would cause a decline in personal consumption, increasing food insecurity, a wave of evictions, more job losses, and even a wave of mortgage default. So really important to get more stimulus, and hopefully the government will act to be able to make that happen. All right, let's move on to credit union operations now. This first graph just shows different interest rates, the federal funds rate set by the Federal Reserve and the 30-year fixed mortgage rate. And basically you can see that these rates are at historically low levels. Early in the pandemic, the Federal Reserve brought the target range to just 0 to 0.25%. And we see that the 30-year fixed mortgage rate has come down all the way to below 3 on average. So very low interest rates. And we think that this is going to continue at least for the foreseeable future. So this, on one hand, is good for credit unions who are able to do a lot of mortgages with increased mortgage demand, but it is going to put increased pressure on earnings at credit unions, as this is going to decrease interest rate margins, especially going into next year. What are we seeing in terms of loan growth at credit unions? Well, this breaks up loan growth into 7 key portfolios over the last 6 or 7 years. We can see that credit cards, for example, were growing at a rate of about 6 to 7%. But so far in the first 6 months of this year, they've fallen about 8%. Other unsecured loans have actually gone up 12% in the first 6 months of this year. And that is largely due to credit unions doing a lot of different loans to help people during the pandemic, including emergency loans and PPP loans, I believe, also fall into this category. New auto loans were on a downward trend before the pandemic and are down 4% so far this year. However, used auto loans are actually up 2.3%. So that's 4.6% on an annualized basis, which would be even stronger than last year. But first mortgages are really leading the way, up about 6%. Again, this is the first 6 months of the year, so annualized, this would be about 12%. That would be the fastest growth in first mortgages in at least 6 to 7 years, as you can see there, and probably before the Great Recession. HELOC and second mortgages are down, and commercial loans have actually been a bright spot as well, up about 8%. So overall, credit union loan growth has actually been quite strong. It's up already 3% during the first 6 months of the year. So we expect it's going to land at about 6% this year and probably about 6% next year as well. This is really being driven by the growth in first mortgages, which account for over 70% of the credit union loan growth at the moment, and has really differentiated this from the Great Recession, when loan growth fell 1.2% due to the decline in mortgage lending as well as other categories. Next year, we do think that mortgage lending is going to drop off a bit because people, of course, only have so much equity in their homes to be able to kind of refinance. There's also going to be the 0.5% adverse market refinance fee that's going to take effect in December. So that's probably going to decrease demand a bit as well. But we do expect an increase in demand in some other areas like auto lending and credit cards. So we expect loan growth of 6% this year and probably about 6% next year as well. but the composition of loans next year will be a little bit different, with a bit less mortgage lending, probably a bit more other consumer lending. Credit union savings has been up an incredible 12.6% so far this year in just the first 6 months. We believe it's going to be on track to reach almost 19% for the year. And that's due to a number of factors. One is the government stimulus, which of course came in, that hit credit union deposits and really increased them. Last quarter, we also had tax refunds that increased credit union savings. But generally speaking, you can see during these recession periods, credit union savings tends to go up. This occurred in the 2001 recession and also in the Great Recession. And that's because people just become a little bit more cautious. They're worried about the future. They feel a lot of uncertainty. So they pull back on borrowing and they increase saving whatever amount they're able to. Of course, a second round of stimulus checks at this point does seem unlikely, at least this year. So we have savings growth dropping off a little bit towards the end of the year, and then next year going back to its sort of long-term rate of growth of about 8%. Credit union portfolio quality actually decreased in the second quarter. Both the delinquency rate and the charge-off rate decreased. This is due to a number of factors, including relatively strong loan growth, and of course, credit unions working with members to modify and defer loans and avoid delinquencies and charge-offs. But of course, that can only go on for so long. So we do see the delinquency and charge-off rates increasing modestly to about 1% and 0.64% by the end of this year. Next year, we think that those rates are going to continue to increase a bit as these modifications and forbearances expire and temporary unemployment becomes permanent, and the government stimulus, of course, dissipates as well. So we expect delinquency rate of 1.1% next year, charge-offs of about 0.8%, but you can see that this is actually well below what happened during the Great Recession. So we don't expect things to get quite as bad as during the last recession. Credit union earnings also increased in the second quarter from 0.53% to 0.61%. It's at about 57 basis points so far in the first 6 months of the year. Of course, credit union earnings dropped quite a bit as credit unions were increasing their loss provisions. But overall, it has been relatively strong for a recession. We do expect earnings to fall to about 50 basis points this year, and then even further to about 35 basis points next year. And that's really due to declining interest rate margins given the low interest rate environment. The current loans are going to be paid off that have a little bit higher interest rates, and new loans and mortgages that are coming on credit union books are going to have very tight interest rate margins. So that's going to put downward pressure on earnings. Now, all of that, of course, is speaking about the credit union industry as a whole, but we're very aware that credit unions, of course, are going to be very different depending on where they're located, their size, their field of membership. So this just breaks up earnings by asset size. So it looks at the median ROA by asset size for credit unions that are under 50 million, 50 to 250 million, 250 to 500, and then over 500 million. And you can see, even going up to 2019, these smaller credit unions, the typical credit union with less than 50 million in assets, only had about 50 basis points of earnings. So we know that a lot of these smaller credit unions are really going to be struggling through this. Nonetheless, if we look at our overall forecast, we see that the net worth ratio has come down quite a bit from 11.4% at the end of last year to 10.5% so far this year. We expect it to continue to decline, but it's still well above the undercapitalized level of about 7%. And most credit unions, the vast majority, are still well capitalized. So they should be able to use their capital to be able to serve their members and weather this storm and continue to do just fine. As always, you can find more on our website at cuna.org/economics. Thanks for tuning in to the CUNA Economic Update.